Welcome back to the channel, everyone. I am Skylar James, and today I've got a pop quiz. Which ETF will generate the best returns for 2021? Do you know? I don't really know either, but we can guess. Just like we can guess which stocks will perform the best. Hit that subscribe button and ring that bell. Helps motivate me to keep producing these videos. Back to our ETF Pop Quiz. Let's set aside the rat race and instead invest in the company raking in huge profits from our collectively insatiable desire for ETFs. That company is Blackrock. This video will find out why you should stop, not have your next investment be in ETFs, but rather invest in the king. Look, I get it, we love ETFs for their inherent diversity, and we apparently love holding a diverse range of ETFs. There's this rush that comes from chasing investing themes, having a hunch, playing positioning games with our holdings. This jockeying is part of what makes investing fun. Every year there's a new ETF champion. It never fails. And every year, investors run out and buy the latest and greatest ETFs as they gain steam or to cover a certain market, sector, or niche, hoping that this choice is the one that generates massive returns. Some of the time, that doesn't work out so well for us. Maybe you bought clean energy ETFs in January of this year. Maybe you bought JETS in January of 2020. Or that marijuana ETF in 2019? Well, we can't win them all, right? I'll name you 5 people who do consistently win at this crapshoot though. Are you ready? It's Charles Schwab, Vanguard, Blackrock, Invesco, and State Street. Okay, yes, they aren't actually people, but they are winning. They are the biggest ETF issuers on the planet right now. And they're winning because they make money every time you and I buy an ETF. How much money? In the case of Blackrock, the owner of iShares, they're pulling in about $4 billion a year just in ETF management fees. $4 billion on these fees. These mostly passive instruments come with huge profits for Blackrock, because managing money apparently makes money. iShares leads its competitors by a mile in terms of assets under management. The 10 biggest iShares ETFs alone have $900 billion in assets under management. State Street, the 3rd biggest ETF issuer, barely manages over $900 billion in total for their entire ETF portfolio. State Street is public just like Blackrock. If more assets under management generates more money in fees, why invest in State Street when you can have the AUM leader, which is Blackrock? And they lead not just in total assets under management, but they tend to be the biggest asset manager in each of the niche ETFs as well. Scan a few with me. Here's semiconductors. SOX, SOXX is the leader there by Blackrock. China, MCHI, and FXI, defense, ITA. We could run through every category, and statistically speaking, you're making a safe bet if you bet Blackrock is at the top of the AUM. You know the investing adage, follow the money, right? Anytime I'm choosing an ETF, I compare assets under management just like this. ETF Homework 101. The bigger the fund, the more stable. The bigger the assets under management, the more stable. Now, Vanguard is a beast in the ETF space too. They have 1.7 trillion in AUM. They're the 2nd biggest issuer. In fact, they're the 2nd biggest overall money manager in the world, not just ETFs. But we can't invest in Vanguard. They're not publicly traded. So for now, let's set them aside. Recognize their dominance, you recognize it, but they are a square peg for this round hole investment strategy. Go back to that headline of 8.7 trillion in assets under management. That was the figure at the end of 2020 and includes retail, institutional, and iShares assets. That's 17% more money than they managed the prior year. They are the largest money manager in the world. It's not often that you are the largest in the world at something and still growing like this. Using the rule of 72, they would double their assets under management every 4.25 years. Assets under management grows in two ways for these guys: organically, through new money coming in, and inorganically. Take a simple example of inorganic growth. The stock market rising increases the value of underlying assets and therefore generates more in total fees. This, in my opinion, is a rock solid business model. Blackrock Q1 earnings are right around the corner, and what better news to hear as we round that corner than this headline out from Bank of America: inflows into equity funds in the 5 months after Election Day exceeded the amount that flowed in during the previous 12 years. Without question, BlackRock stands to gain from this. How much new money is BlackRock managing? I can't wait to see in their latest earnings release. I'm predicting big time money. The stock has seen massive price appreciation during the last 12 years of bull market that Bank of America is referencing in their note. What is the stock going to do if assets increase another $500 billion in just a quarter? Boom, boom. Did you catch this headline recently? BlackRock launched a new environmental, social, and governance ETF, and in day one, it drew $1 billion in assets. Day one! ETF management is a booming business. Remember, business, not charity. They're here to make money, and they are rewarding shareholders. Had you purchased BlackRock shares 5 years ago, you would have generated better returns than the S&P 500, and BlackRock has a sweet 2% dividend on top of the strong price appreciation. I want to own the best ETF manager. Just like when you're picking teams, you want to pick the best dude on the court, right? I'm going to pick the strongest stocks and the best ETFs, which of course are predominantly managed by BlackRock. BlackRock's addressable market is growing. They have massive organic and inorganic revenue growth, and they're an all-around solid company with strong financial tailwinds. Score! Look, here's the bottom line. You can chase ETFs and have FOMO over this index or that innovation suite. I can throw darts at a board and hope I allocate my portfolio to the strongest ETFs and indexes. But I view BlackRock as the ultimate pick and shovel play to capitalize on the ETF popularity boom. And in this boom time, this bull market with GDP expansion where investors are dumping money into the market, I want to be positioned to reap the reward. So I'm choosing BlackRock. What do you think of this strategy? Will you own the ETF issuers to take advantage of the ETF craze? Leave a comment below and tell me why.